Hello traders. Welcome to the Skynet FX Algo YouTube channel. In this video we will be talking about how to read market structure like a pro. If you don't know how to analyze market structure, how to mark break of structures and to identify the trend, this is the right video for you. In trading, market structure is the foundation of every single strategy that is formed by traders. For you to improve as a trader, you need to understand the basics of how to read the market structure. You have probably heard a lot of people say they are price action traders. So what does price action actually mean? Imagine this like when people come together and they agree on a price on a huge scale. There is a constant decision process that has to be made of what is expensive and what is cheap. The market goes down, this means expensive, and the market goes up, price is cheap. There is that constant battle between buyers and sellers, between supply and demand. We will be having buy and sell orders in the market. When buyers are more than the sellers, the price moves up and creates an uptrend, and when sellers are more than the buyers, the price moves down, creating a downtrend. Usually the majority will always win. The trading charts are a visual representation of transactions and the ending price at times. Price is always the same. The time frames just represented with different ways, either with less or more detail. So if you are in a monthly or weekly time frame, you are not going to have a lot of detail. But when you drop into the 15-minute all the way down to the 1 minute, you are going to have lots and lots of detail. Let's get into the market structure. Market structure is the strongest foundation of technical analysis. It is the breathing pattern of the market. Price goes up, takes a breath, and goes down. Understanding the simplest concepts of higher highs and higher lows, or lower highs and lower lows, contributes to 50% of your profitability. Market structure also illustrates who is in control, whether the market is buying or it's selling. We use is to identify the major trend and minor structure. I want to ask you a question. What are the two ways the market is moving? In essence, the market is always buying and selling, so when it buys, the price goes up, and when it sells, the market goes down. The market is usually doing two things. Number one, the market can be trending, an uptrend or downtrend. Number two, the market can be consolidating, ranging, choppy and unclear. So this is the rule that I want you to remember. It's called the no overcomplication rule. When you open your charts, the first thing you ask yourself is the market up, down, or sideways? It's pretty much easy to spot it. So let's talk about trending markets. An uptrend is defined as market structure that breaks highs and maintains the lows. In simple terms, it's a market making higher highs and lower lows. As you can see in the image, the previous higher highs should always break, while the previous higher lows should not break. So basically, in an uptrend, we always look for buys only. You must always trade with the trend, and this increases your win rate percentage. For a downtrend, it's defined as market structure that breaks the lower lows and maintains the lower highs. In a downtrend, we only look for sells. For the consolidating market is a ranging market that moves sideways. You trade when price breaks out of the range, either up or down. So now let's look at how you draw and analyze the market structure. Using the no overcomplication rule, you have to observe whether price is moving up or down. We can see that on the left, price is moving down, meaning it's a downtrend, and on the right it's moving up, meaning it's an uptrend. The market structure should be drawn like this. Always mark your major structure with a dash bold line. For a downtrend, use the red bold line to mark lower lows, and for an uptrend, use the green bold line to mark the higher lows. So there is our lower highs for the downtrend, which are the major highs in a downtrend that are not supposed to be broken. We can see that there is the break of structure of the lower low, and if you trace back the move, we can see that this is the lower high that is not supposed to break. Again, we see the same thing, a break of structure. What caused the break of structure? It's the lower high that is supposed to hold to form a downtrend. Now we can see a trend shift which indicates a reversal of price from a downtrend to an uptrend. This is shown by a break of price in the previous last lower high that was supposed to hold and a failure to form a new lower low. The market then formed a higher high then a higher low. Again there is a break of structure of the higher high, and if we trace it back, the higher low is the one that caused the break of structure, maintaining the uptrend. We see this again and again as price continues to go higher and higher until another trend shift occurs. This is the end of the video. Stay tuned for another video, and thank you for watching until the end. Follow and subscribe for more.